When trying different things, you've got to have some acceptance of failure, as you were alluding to earlier. Failure must be an option. If failure is not an option, it's going to result in extremely conservative choices.
Investing isn't just about chasing profits, it's about balancing opportunity with risk. Professional investors understand that returns and losses are two sides of the same coin, and mastering the art of risk management is what separates top performers from amateurs. Today, we're diving deep into how professional investors strategically manage risk while maximizing returns, revealing the principles, habits, and strategies that allow them to thrive in volatile markets. These lessons are practical, actionable, and proven over decades of high-stakes investing. One fundamental strategy professionals use is diversification. Top investors never put all their capital into a single asset or sector. Ray Dalio, for example, structures portfolios to balance exposure across stocks, bonds, commodities, and global markets. Diversification reduces the impact of a single loss while maintaining growth potential. Many amateur investors make the mistake of concentrating on one hot investment, which amplifies risk. By spreading investments intelligently, professionals can capture returns in one area even if another underperforms. Diversification isn't just about spreading money, it's about strategic allocation that maximizes risk-adjusted returns. Another critical principle is research-driven decision-making. Professionals don't invest based on speculation, hype, or emotion. Warren Buffett famously studies businesses for hours, analyzing financial statements, competitive advantages, and long-term growth potential. Cathie Wood invests by evaluating adoption trends, innovation trajectories, and market disruption potential. Thorough research minimizes uncertainty, giving investors confidence in both upside and downside scenarios. Amateurs often chase trends without understanding the underlying fundamentals, exposing themselves to high risk. Knowledge is the most powerful hedge against uncertainty. Position sizing and capital allocation is another key technique. Professionals carefully determine how much capital to allocate to each investment based on risk, opportunity, and portfolio strategy. By limiting exposure to any single asset, they prevent catastrophic losses while still participating in potential gains. Elon Musk, for instance, invests in ventures with high potential but keeps exposure proportional to overall risk tolerance. Amateur investors frequently overcommit to a single opportunity, magnifying both psychological stress and financial risk. Proper allocation allows professionals to survive setbacks while compounding returns over time. A major tactic is using hedging strategies. Professionals often hedge against market downturns or sector-specific risks using options, futures, or inverse ETFs. Hedge funds like Bridgewater Associates employ sophisticated strategies to protect capital while seeking growth. Hedging isn't about avoiding risk entirely. It's about controlling exposure to downside while maintaining upside potential. Amateurs rarely use these tools, leaving portfolios vulnerable to unexpected shocks. When applied strategically, hedges allow investors to take more aggressive positions safely, maximizing returns while containing risk. Understanding intrinsic value versus market price is another critical concept. Professionals buy assets when prices are below intrinsic value and avoid overvalued assets. Warren Buffett's approach emphasizes purchasing quality businesses at discounted prices, ensuring a margin of safety. This reduces downside risk and increases potential returns. Amateurs often chase momentum or panic, sell during market fluctuations, ignoring fundamentals. Evaluating intrinsic value provides a buffer against losses and allows investors to capture profits when markets eventually recognize true worth. Risk is also managed through psychological discipline and emotional control. Fear and greed drive poor decision-making for many investors. Professionals train themselves to remain rational under pressure, making decisions based on data and strategy rather than emotion. Buffett advises being fearful when others are greedy and greedy when others are fearful. Emotional discipline allows investors to exploit market inefficiencies instead of being victimized by them. Losing control of emotions can amplify risk, whereas professional composure transforms volatility into opportunity. Another key approach is long-term horizon investing. Professionals rarely chase short-term trends. They focus on sustainable, compounding returns over years or decades. By ignoring daily market noise, they reduce the risk of impulsive decisions that can erode returns. Jeff Bezos invested in infrastructure and innovation for long-term growth, even when short-term profits were minimal. Amateur investors often seek quick wins, exposing themselves to volatility and losses. Long-term thinking aligns risk and reward with enduring business fundamentals, producing steady, significant returns over time. Stress testing and scenario planning is another hallmark of professional investors. They anticipate market shocks, economic downturns, and unforeseen events by modeling multiple scenarios. Bridgewater Associates famously uses this approach to prepare for diverse macroeconomic conditions. Planning for different outcomes reduces surprises and allows rapid, informed responses. Amateur investors often fail to anticipate crises, reacting too late and suffering avoidable losses. Scenario planning transforms uncertainty from a threat into a strategic advantage. Active monitoring and rebalancing is a continuous process. Professionals consistently review portfolios, adjusting allocations to reflect market changes, sector performance, and evolving risk profiles. Warren Buffett and Cathie Wood routinely reassess positions to optimize risk-adjusted returns. Rebalancing ensures that gains are locked in, losses are mitigated, and exposure aligns with evolving objectives. Amateur investors often neglect portfolio maintenance, letting imbalances grow into vulnerabilities. Regular review is essential for maximizing returns while controlling risk. Leverage and borrowing strategies are handled cautiously. Professionals understand that leverage can amplify returns but also magnify losses if misused. Elon Musk and institutional investors use leverage strategically, carefully calculating potential outcomes. Amateur investors sometimes over-leverage, exposing themselves to catastrophic losses. Prudent leverage enhances performance without compromising capital preservation. It's a high-reward tool only when paired with discipline, risk management, and contingency planning. Another tactic is portfolio concentration in high-conviction ideas. Professionals don't diversify blindly, they balance broad exposure with targeted high-confidence positions. Buffett often holds large stakes in companies he understands deeply. Cathie Wood concentrates on sectors where research indicates exceptional long-term potential. Strategic concentration increases returns while managing risk through deep knowledge. Amateur investors may over-diversify, diluting returns and failing to benefit from high-conviction opportunities. Focused expertise is a powerful multiplier of results. Learning from failures and historical patterns is another key principle. Professionals study market history, past crises, and mistakes to improve risk management. Dalio documents successes and failures to refine future decisions. By understanding what went wrong previously, investors anticipate pitfalls and avoid repeating them. Amateur investors often ignore lessons from history, making reactive decisions that compound risk. Historical insight allows professionals to act proactively, increasing the probability of maximizing returns. Liquidity management is another pillar of risk control. Professionals maintain sufficient cash or liquid assets to navigate downturns and seize opportunities. Warren Buffett holds cash reserves to invest during crises, capitalizing on undervalued assets. Illiquidity can force sales at losses and limit flexibility. Amateurs often invest all capital in illiquid assets, risking financial paralysis when markets fluctuate. Maintaining liquidity ensures resilience, opportunity, and flexibility, critical elements in risk-adjusted investing. Finally, professional investors align risk tolerance with personal and institutional goals. Not every investor can withstand volatility. Professionals tailor strategies to objectives, time horizon, and comfort level. This alignment prevents panic-driven mistakes and ensures consistency. Jeff Bezos, Buffett, and Dalio match strategies to long-term visions, maintaining discipline under pressure. Amateur investors often adopt inappropriate strategies, leading to stress, impulsive decisions, and reduced returns. Understanding personal risk tolerance is as important as analyzing markets. By following these principles, diversification, research, position sizing, hedging, intrinsic value analysis, emotional discipline, long-term focus, scenario planning, rebalancing, cautious leverage, high conviction concentration, historical insight, liquidity management, and goal alignment, professional investors manage risk while maximizing returns consistently. These strategies aren't theoretical. They are applied by the world's top investors to produce extraordinary, sustainable performance in any market. Implementing these tactics begins with clarity and discipline. Define risk tolerance, conduct thorough research, diversify intelligently, establish contingency plans, and maintain emotional control. Monitor performance, rebalance portfolios, and reinvest strategically. Combine long-term vision with high-conviction bets and disciplined leverage to maximize returns. Over time, these principles compound into wealth preservation and growth that amateur investors rarely achieve. The key takeaway is clear. Investing like a professional isn't about avoiding risk. It's about understanding it, planning for it, and using it to your advantage. Professionals convert uncertainty into opportunity, protect capital without sacrificing potential, and consistently optimize for risk-adjusted returns. By internalizing these strategies, anyone can approach investing with the mindset, discipline, and execution that produce extraordinary long-term wealth.